All right. Good afternoon, everyone. My name is Omolola, and I'll be moderating today's webinar. Of course, I would like to welcome everyone on the call. And of course, it's time for the PAC Capital webinar. And so, prior to that, I'll need someone to please confirm if they can hear me, probably in the comment section. I just need a confirmation. Please, I'll be waiting. All right, thank you very much, Mr. Bolarinwa, for the confirmation. Of course, like you rightly said, I was muted. Now, again, I would like to officially welcome everyone, to today's webinar hosted by PAC Capital Limited. Themed value optimization, leveraging the capital market advantage. My name is Omolola Ojo, and I'll be your moderator this afternoon. It's such a pleasure to have you join us. I know it's raining in several parts of Nigeria today, and rain always seems to bring with it a certain mood, sometimes cozy, sometimes chaotic. And so, as a level of, let's just get around things. Tell me in the chat how the weather is where you are. And most importantly, how are you doing today? And of course, please just type your response. And of course, let's loosen up a bit before we dive into the meaty conversations I had. I am looking at the comment section just to see, one or two feedback by our participants. Of course, to make things clear, we can leverage the Q&A box. For some reason, I can't see the chat box. I wouldn't know if any other person can. If you can, please let me know. Also, in order to, give some people more time to join us today, I would like to share just, a little video, a short video that showcases the impactful work PAC Capital is doing in the financial advisory and investment banking space. And so I'll be sharing the video shortly with us. Please stay with us. Thank you. All
When
right.
we think of bespoke financial advisory and capital raising solutions, what comes to mind is impact and borderless access to unlimited.
Thank you so much for watching. To officially kick off the session, please join me in welcoming Chinonso Osuji, a Vice President at PAC Capital, who will be giving the opening remarks on behalf of PAC Capital.
Good afternoon, everyone. On behalf of our Managing Director and the management of PAC Capital, we want to welcome everyone to this very insightful session. We have put together a team of experts, across various sectors, to ensure that, most especially with the expertise, in the capital market, to ensure that we as a team are able to always, deliver excellence, in our services to you. So it is our hope and anticipation that this session will leave us more enriched in terms of our knowledge about the capital market, and the various discussions will very much contribute to both our understanding of the market and our application of the advantages that the capital market provides to us. So I once again welcome you all on behalf of our Managing Director, and wish us a very, very insightful discussion and deliberation in this webinar. Thank you.
Thank you very much, Chinonso. Thank you for the introduction. And now, to give us a deeper understanding of PAC Capital's legacy and expertise, please welcome the Executive Director, Mr. Bolarin Wasani, for his speech. Thank you.
Okay, thank you, Omolola, for anchoring this. Good afternoon, everyone, and thank you for taking out part of your afternoon on a raining day like this to be with us. We do not take it for granted. We really appreciate your time, and we believe that it will be a time well spent with us as we take a deep dive into the value that can be optimized from the capital market window. My job is well defined. Is to introduce the PAC Capital brand to our esteemed audience on this webinar. PAC Capital Limited is an investment banking firm. Our specialty is in financial advisory and fundraising. And on the fundraising side, that covers a huge spectrum. And narrowing it down to the focus of our discussion today, to interest you to know that we are SEC licensed issuing house, also with the ability to underwrite in the capital market space. We've been doing this for close to 2 decades with success stories to show for our presence in the. I'm sure you can imagine, the capacity that gained over the space of period. Some of the interesting transactions that I would like to highlight to demonstrate our experience within the capital market space that we did of recent includes our participation in the TGI Foods commercial paper, the size of 20 billion. We're a joint dealer and an arranger on that transaction. The same vein, we handled the NIMET rights issue that was done to the tune of 3.6 billion naira as a lead issuing house about 3 years ago. We were also very much active in the recently concluded Providence Bank commercial paper. which are the size of 50 billion naira, where we played the role of a joint issuing house as well as a dealer. TSL bond issuance is not left out of what we've done in recent times to the tune of 5 billion and played the role of a joint issuing house. I mean, there are a host of transactions of this nature. I mean, if I spend time reeling out our tombstone within the capital market space, I'm sure they will speak for itself in terms of our expertise and experience within that space. And not leaving out our other, the other side to our business, which is, playing in the unregulated space, raising funding from, DFIs, export credit agencies, international financial institutions, and the likes, covering a large spectrum of financial institutions across the globe. And we have recorded tremendous success in this area over the years. And that has continued on an increase. And we make bold to say that in terms of our coverage as an institution, we are not limited to the Nigerian market alone. Africa is our focus, and of recent, we have also expanded that reach into the Caribbean. And the key consideration for that is the fact that we see a whole lot of similarities between the African region and the Caribbean, pretty much broadening it to align with the term global Africa. Currently, we have live transaction in about 30 African countries, and I can make bold to say that our intention is to increase that to cover the entire region. We are always excited to provide services to your good self, either as a corporate or as a government institution, and in areas where there is a collaboration between the corporate and government institution in the form of public-private partnership. We are always delighted to provide the necessary support, raise the required funding, and ensure that the transaction, irrespective of the peculiarity, we are able to come up with solutions that delight our clients. Our pride is always ensuring that our clients, their objectives are met, and we can say that we have consistently kept to this intent always to our clients. This is who we are, and this is what we do at PAC Capital. We look forward to working with you, as we believe that the outcome of this session would delight you to take advantage of the opportunities that abound within the capital market window. And if you look for a partner in an issuing house, I can tell you that you have a right partner in PAC Capital, and you will never regret working with us. Once again, I welcome each and every one of you to this session, and we look forward to a very robust and exciting panel session. Thank you.
Thank you very much, sir, for that comprehensive review. And of course, based on what you said, there's so much that PAC Capital has to offer. Now to the core of our session, our panel discussion. We have a distinguished lineup of speakers who bring deep insight from across the capital market value chain. Now, let me introduce them. First, we have Ejovi Okekpapo, Senior Associate at PAC Capital. We have Mr. Bamidele Ige, the Managing Director of PAC Asset Management. We also have Mr. Yinka Adigbola, the Managing Director of PAC Trustees. Now, joining us from outside the walls of PAC, we have Mrs. Aziza Muse Sadiq, who is a partner at Banwo and Igodalo law firm. We also have Mr. Oluleye Ademola, the head of investment at VG Pensions. And lastly, we have Mr. Orisha Jimmy Ububene, who is an associate director at Augusto and Co. Welcome, everyone. And of course, it's a delight to have everyone here with us on the call. Now, to the segment, right? I would want us to start the conversation today, around the issue, around the arrangees, where you're talking about deals and transactions, and those people that actually provide, the bridge. And so I want to start with P as a capital. And so my first question is to Ejovi. Now, thank you, Ejovi, for joining us here today. My first question to you is, in light of Nigeria's economic growth needs, now, what do you see as the role of capital markets in achieving national transformation?
Good afternoon, Amodola. Good afternoon, everybody. I would like confirmation that you can hear me before I proceed.
Yes, I can hear you and I can see you. Thank you.
All right, fantastic. So, good afternoon once again. I would like to thank you for that question, because the question is a very, very important question, because it's very, very tough or it's practically impossible for a nation to achieve its developmental goals and objectives without an active and vibrant capital market. Firstly, if you do like just a simple research into the most developed economies all over the world, what you will find is that a lot of or all of those economies have vibrant capital markets and a properly regulated capital market with rules and all that guide the allocation of financial resources from one part of the market to another. Because if an economy must develop, there has to be a way of accessing funding for businesses, innovative businesses that can drive growth and solve problems. There has to be a way of accessing funding for infrastructural and developmental projects. For example, the government wants to do some repairs or build some infrastructure, The government needs to have a platform for raising funds to meet its objectives and can be structured over a long period of time to afford for a convenient way of repaying, and also for projects as well, be it in the government sector or in the private sector. There's also need for funding as well. So definitely the capital market it's a very, very important driver of development. More specifically, what would the capital market do? First of all, it will assist in the mobilization of savings with instruments like bonds, stocks. The capital market will assist in pooling savings for those who have some spare cash, and that savings can be channeled into subscription into instruments issuances from different capital market companies. The capital markets have it facilitates allocation of resources, as I mentioned before, because there are times you have companies that have innovative ideas or innovative businesses that are designed to solve problems, alleviate poverty and concerns, and then funding to actually drive the business to a much bigger scale becomes a problem, or drive funding to move the business to the next level becomes a problem, which is where the capital market comes in. It makes it possible for businesses or companies that may not qualify for the kind of credit you would get in, for example, in the banking space, to have access to funding as well. So it's that's one of the importances of the capital market. And also, it is a signal of economic growth. Usually, when things begin to pick up in an economy, one of the first things you see is the improvements in the capital markets. You see an appreciation in stock prices, which usually is a signal of an improvement in investor confidence. So definitely the capital market is very, very important. If any economy must witness sustained growth and development over a period of time, it definitely needs the support of the capital markets.
Right, thank you very much, Ejovi. And honestly, stay with me. I would like to bring up Mr. Orisha Jimmy at this point. And the reason is because going by your response, it seems like there's so many players in within the capital market space. And most of the time, in terms of what people can invest in, what investors would invest in, and all these concerns now, people are always concerned about the credibility, right, of whoever it is they go to at this point. And so I would appreciate if Mr. Orisha Jimmy, please confirm if you're on the call, sir. For some reason, I can't see.
I'm on the call.
All right, sir. All right, sir. Good afternoon, sir. And thanks for joining us. And so I want to use this moment to spotlight the role that credit rating agencies like Augusto and Co. now play in within that market. And so my question to you is, how do they influence investor perception and cost of capital? And how can issuers proactively manage their ratings to enhance value?
Okay. So just to recap all you've packed in this question, you're asking how ratings can impact cost of capital, how it affects investor sentiment.
Yes.
Okay. Did I leave out any other thing?
Yes, there's one more question, and that is, how can issuers proactively manage their ratings to ensure
Okay.
value, compliance value?
Okay. Okay. Nice. Thank you. So I'll just start from the basic education of this in terms of how ratings play out, how it affects investors' cost of capital, and how it affects investors' sentiment. And at Augusto, we typically tease that we are the market guardians. We are the market guardians in terms of like providing some guardian angels. So just think about it from that perspective. And I could share a simple story with you. There's a practical true life story. It happened to me right on this desk. So once there was a default on a particular instrument and we're conducting some research into default histories in Nigeria, and so we're going back into conducting some form of historical study. So we then contacted some of the market operators, some of the financial advisors who had worked on this. And after a while, and as the questions kept pouring in, they then said to us that the gentleman said to me that, you know what, we've put this deal together and the deal is no longer in our hands. So in other words, could you end this round of questions? Okay. But the rating agency can't say this. So what's a rating? A rating basically evaluates the risk of an issuance or an issuer. An issuance being, if it's a debt instrument, for instance, maybe, which means a bond, what's the risk evaluation of this bond? In other words, how would the obligors behind this bond, how would they be able to meet their obligations to their creditors? And if it's a rating on an issuer, it means that this issuer, XYZ Nigeria Limited, that is raising this bond, what's the risk perception, especially in terms of credit worthiness of this XYZ Nigeria PLC? So if you're rating, and for many of you who may be new to ratings or trying to get a better indication, you could typically have like a 9-scale rating grid, which means at the top of the rating grid, you've got A written 3 times, known as triple A. Okay, and depending on whose rating grid you're looking at, it could go all the way to C or D. And as you go further down the rating scale, it indicates that the risk is getting higher. So a triple A rated instrument has lower risks than a double A, a single A, and then after the A's, you get into the B's, triple B's, and all along all that way. And then to hit the heart of your question in terms of cost of capital, there's what is known as investment grade ratings, which is triple B and above. In triple B and above, I'll tell you the short story behind this. In the United States, students of economic history would have heard of the Great Depression in the 30s in the US. So in the US in the 30s, when America was facing heightened economic risk, as part of the reforms that came up in the US, pension funds were told that they could only invest in instruments that were rated triple B and above. So that's how triple B and above became known as investment grade. So what this typically portends is that triple B and above is known as investment grade. In Nigeria, for instance, you've got lots of rule books guiding investments, maybe policy guidelines, investment policy guidelines. In the pension fund industry, for instance, the regulator in the pension space says that pension fund administrators can only invest in investment grade ratings, which means any instrument rated triple B and above. So any instrument rated below triple B, pension funds who have the largest pool of long-term investments can then not invest in such instruments, even though you've also got things like credit guarantees being provided by institutions like InfraCredit, who can help provide a guarantee as a result of a credit wrap, because InfraCredit has got the triple A rating. They then provide a credit guarantee and can enhance that rating via a credit wrap. So investor sentiment is such that the higher the rating, the lower the risk. And in finance, the lower the risk or the higher the risk, the higher the expected returns. So if you've got investors, for instance, who say, we do not mind junk bonds. So junk bonds are anything rated below triple B. We do not mind junk bonds. Why would an investor say, I don't mind junk bonds? Because they are high risk investors who are looking for higher yields. So those are yield hunters, looking for higher yields and not too worried about risks, or more worried about yields. So they don't mind going for junk bonds, which attracts higher yields, or which should attract higher yields. But I also gave you another category of investors like pension funds, who are low risk investors because of the nature of the underlying assets. They are key stakeholders, who are their major stakeholders, the savers. So I'm sure all of us on this call who have got pension fund assets being managed wouldn't want to hear that our pension fund company has lost our money because they took some undue risk. So these ones are typically looking for investment grade ratings. And then in terms of issuers, so the third part of your question, what should issuers think about? For issuers, I think the important thing is this. There has to be a journey. Sometimes from a rating perspective, what do the rating agencies see? A company that, or an issue that, for an issuer or even both, that it should be clear. Have you raised your client's expectations to the point where an issuer has overpromised? An issuer has said, oh, I can raise you 100 billion in the market, and then the rating behind this promise is now a junk because all of the financial criteria and all of the management criteria and everything that goes into a rating, those company falls below the standard, so much so that it now threatens the success of that issuance. So I think, what do we expect of issuers? I think we expect better financial education from issuers with their clients to help gauge interest. And that's where you see the conflict between the rating agencies and the financial advisors could often come in. Because of the end motive that you're trying to raise an instrument and then you're fighting the rating agencies, which doesn't change a thing anyway for the rating agencies. So I think there's a better need for increased investor education. Investor education would mean all market stakeholders, investors, financial advisors, issuers on all of these issues around ratings. Now, I have a personal pet peeve as well, that the Nigerian market, and it's a personal pet peeve, this is not Augusto's opinion here, that the Nigerian market should be expanded to allow more junk instruments, and then investors are clearly educated that this is a junk instrument, it attracts higher risks, or you can gain higher yields on it. And that's what you have in more mature markets like the US, where there's a vibrant junk market and also a vibrant investment grade market. So even though Nigeria is probably the second most advanced debt market outside of South Africa in sub-Saharan Africa, and even I dare say top 5 across the continent, and that's when you include North Africa, which typically has a bit of advancement in quite a number of economic areas than the rest of sub-Saharan Africa. But the Nigerian market is that advanced to be top 3. So I think the next area for us is to begin to say that every instrument shouldn't be investment grade. And here am I going rogue right now. Every instrument shouldn't be investment grade, but investors should be well educated on the risks and opportunities that come with the different classes of ratings on instruments. Okay, I think I'll just take a pause here.
Thank you very much, sir. And honestly, you've shared a lot. And one thing that stood out to me is the bit on the investor education. And I think that's great. And of course, it speaks to the event that we have today. And so I'd like to thank you for that. Thank you so, so much, sir. And so, Ajovi, I believe you're there. I ask that you please stay with me. And of course, thank you for staying with me. So I want to bring your question back to you before I then proceed, to engage other panelists. And so, what Mr. Orisha Jimmy has talked about, instruments, and of course advocated for the Nigerian markets to embrace more junk instruments. Now, what I want to know from an issuer perspective is what innovative capital raising instruments or strategies have proven effective, right, in unlocking value during volatile macroeconomic conditions. I mean, based off of the experience and of course what you do at PAC Capital.
Your question, in the history of the capital markets, there has been a lot of evolution, since the capital market started up to the past couple of years. We're beginning to see a lot of evolution. Issuers and financial advisors are beginning to get creative as regards structuring transactions or trying to introduce new instruments into the market so that issuers can meet their financial objectives and goals regardless of where they are in their growth story. Like the last speaker mentioned, in fact, what I would love to see in the market over the next couple of years is the issuance of junk bonds, subject to a very comprehensive investor education, such that an investor is fully aware of why it is a junk bond, why the yield may be way higher compared to the yield on another instrument that has a much better credit rating and also has something like some credit one of the things you will see is that the SIMS, our Nigerian federal government, is getting more interested in the issuance of sukuk, which is also referred to as Islamic bonds or Sharia compliance bonds, So it's one of those bond structures such that it doesn't give room for interest, It's there is a revenue sharing arrangement in the sukuk. So it is one of those instruments we're beginning to see more from the Nigerian capital markets, and the federal government says the federal government of Nigeria is really taking advantage of that avenue for capital raise. Of course, the whole thing is handled through the Debt Management Office, which is the DMO. So for the government, there has been a couple of sukuk issuances that has been used in financing a couple of infrastructural projects like road repairs, road development, and all that. That is one. Another one that you will see is the green bond issuance. I think one of the Nigerian corporates issued a green bond about 3, 4 years ago, which is Access Bank. Really, that is another innovative instrument with which a corporate has raised financing in the Nigerian capital market. So, for the sake of education, really, a green bond, summarily, it's used to finance green projects or sustainable projects or ESG compliance projects. So that is another avenue that a company could use to raise funding, or an innovative way of raising funding. And also, there's also the REITs, the Real Estate Investment Trust, which is it's not very far away from mutual fund, but its focus is on it's summary, it is raising capital from investors with a view to invest in real estate that earn income. So that is another avenue. And then I cannot quit this session without mentioning crowdfunding, which is something the Securities and Exchange Commission has published policies around. So you can think of crowdfunding as different sets of retail investors across all the economic cadre, all coming together to fund a business or fund a project, subject to compliance with the rules of the commission, because there are rules put in place to ensure that there is fair play in the market and we do not have aggrieved investors. So that is another innovative way, or a company or an institution that needs some funding can have access to some funding to fund this developmental projects and all that. So
All
I
right.
would like yes, but before I quit, I'd like to also highlight the good work the Securities and Exchange Commission has been doing. I've been in a number of seminars over the past couple of years, and I can see that there is a conscious intention to create innovative products and deepen the market such that anybody can play in the markets, ensure that the rules are complied with, so that we can have a very, very fair practice in the Nigerian capital market. So thank you very much, Omolola.
All right, thank you so much, Ajovi. Now I want to move to other panelists, and of course, I have a question for Mrs. Musay Sadiq. Now, I wouldn't know if she prefers me to use Aziza now, but that's fine. And so, good afternoon, ma'am. Thanks for joining us. So, I want us to talk law, right? And of course, I mean, the capital market is a highly regulated space. And as such, I would like to know, how can legal advisors like Banwo and Igudalu balance the need for regulatory compliance with the flexibility that investors and issuers crave?
I mean, contrary to the general idea or perception that we lawyers just come to bring trouble, we actually do not we don't come looking for trouble. We do not try to complicate. Really, as in capital market, what lawyers do, we always do try to strike a balance between complexity of the structure and the regulation, while still ensuring that we have some level of flexibility. Because as the rules are getting stricter, expectations of investors are different, right? So it's important that issuers are able to issue instruments confidently, innovate confidently while still complying. So any lawyer in capital market space, that's the first thing. We are problem solvers. We are solution providers. We are partners in business. We don't try to complicate. So when we tell you rule X, Y, Z says this, It's for everyone to work together to see how to get to the answer in a compliant manner. So how do we do this? We assist in structuring transaction. For example, in Bawa Nibidal, one of the things we work with is that we are problem solvers and we solve problems within the confines of the law. So in structuring transaction, while still ensuring compliance, if the law or the rule doesn't say you can't, then the client should be able to issue that product, if you get what I mean. So it's that everything you are doing is within the confines of the law. The law hasn't said you cannot do this. So how do we achieve the client's results within the confines of the law without attracting penalty? So one of the things we do as lawyers in capital market space is interpreting the rules and the laws in a manner that allows both the issuing houses and the issuer to issue products and innovate efficiently. Other things that we do include engaging regulator. We always want to support in regulatory engagement to the extent that the issuing houses will allow the lawyers to participate. Because when you have novel products or novel instruments, it's important that you de-risk it to the regulator, because the first reaction of most regulators is that, oh, this thing is going to cause problem, particularly where there are gray areas in the rules. So as lawyers, when we engage and support regulatory engagement, we always just try to de-risk the instrument and give regulatory comfort to the regulator that, okay, so rule XYZ provides for this, it doesn't extend to this, but to the extent that this product is not conflicting on your existing rules, we also encourage regulators, particularly where the product is tied to a rule. So I'll give an example. About 3 or 4 years ago, one of the banks wanted to issue credit-linked notes under a shelf program. Now, because banks in other markets, when you have that loan portfolio, you want to be able to leverage on it, create assets, and pass on the risk or the default risk of your borrower to the market. But you work with the rating agencies to also see which borrower can I pass on. The SEC did not have rules and still doesn't have rules on credit-linked notes. So it was a lot of engagement to see that, look, essentially these loans are assets in the books of the bank. So the same way a company can do receivables backed bonds or the assets backed securities in your rules, look at the loans in the books of the banks as assets, and let us tie the performance of those loans to the bonds that this bank wants to issue. Unfortunately, the transaction did not proceed, but the SEC approved the program and allowed us to create the credit-linked note as one of the instruments that can be issued. So maybe the correct thing to say is that the issuer has not issued the instrument, but the SEC, with regulatory engagement, allowed it to be included as part of the instruments that can be issued under the program. The other thing that lawyers do is in terms of governance and disclosure, because one of the things you see is there's this perception that compliance is expensive. And what I always tell issuers that it is non-compliance that is actually more expensive, because when you comply, you don't pay penalty, right? But once you go on a non-compliance route, then you begin to accrue penalty, and then it makes compliance itself expensive. So it's very important that when an issuer wants to go to the market, one of the things they are wary of is post-listing obligation, those disclosure requirements. So as lawyers, we always try as much as possible to make it easier for them to understand, to also let them know the types of instruments or systems they can put in place to ease compliance as well as disclosure. And I think the last thing I would like to say that lawyers do in the capital market space to encourage innovation is risk allocation and contractual protections. So, for example, in the capital market space, we're all familiar with all of these are structures where you set up a special purpose vehicle, and that special purpose vehicle is the issuer, because the primary company doesn't want to register into a PLC yet. And in order to give comfort to investors, because that SPV is a special purpose vehicle, it has no assets, you will now have a deed of covenant that ensures that the bondholders will look up to the company behind that has the balance sheet to support the process. So it's one of those things that we do as capital market lawyers to support flexibility and innovation in this space. Thank you.
Thank you very much, Mrs. Azina. I think that's so detailed, and of course, we appreciate the insights that you've provided. Now, I would like to invite Mr. Yinka Debola, and of course, the capital market is broad, as we've seen, and so, or we've heard rather, and you get to realize that there's so many players, and so I would like to explore the role that a trustee, right? Plays in within that space. And my question is, how does the trustee role help enhance investor confidence and, of course, preserve value during capital market transactions?
Okay, all right. Good afternoon, everyone. Good afternoon, Mola. I want to confirm you can hear me, please.
Yes, we can hear you, sir.
Okay, all right. Thank you. Let me first of all say thank you to PAC Capital team for putting this together. And thank you to other panelists who have made time out to join this meeting this afternoon. I'll start by saying that, interestingly, in the market, everybody knows what issuers, what they do. People know what registrar, what they do. People know rating agency, reporting accountants. But over the years, you realize that people hardly know what, even after spending years, either in the capital market or commercial banking, as it were. You know, it's funny that you will see that people still don't know what a trustee or what a trust company, what they do. I'll start by saying that for every borrowing or lending, there must be a collateral. And that is the job of trustees. We try to manage the collateral, which has been pledged or which has been used as collateral by a borrower or issuer. You know, we hold the title documents in trust. We do a lot of things, but I'll just say briefly that our role in the market, it's like in 5 stages before transaction, and then in like 3 stages after the funds have been raised. Well, the first thing is that we try to, like I said, we hold assets, collateral and trust. So the collateral, which typically in this part of the world is mostly properties. So the first thing we ask is, where is the title document? We want to see the original. And then when you have to take custody of the original title document, the first thing you want to do is to go and conduct a search or a due diligence to know that, yes, this title document is actually genuine. Now, gone are the days that you just do a search. But nowadays, you want to write to the land registry to confirm that, yes, this title document is not a clone title document. You want to be sure that the title document was actually issued by the land registry in question. Imagine after all the transactions and it's time for you to realize the security and realize that the title document does not exist. Then the burden is on you as a trustee, you know, because in that case, there has been a negligence on your part. You know, that's the first thing which you are expected to do. Then another thing, like I said, I have 5 items I've itemized. The next thing is you want to do the valuation of the asset. You want to be sure that, yes, this asset worth XYZ to be able to take care of the exposure of the issuer or the capital risk exercise. Imagine you have a company has borrowed 5 billion and now later realize that the asset they have pledged is just 3 billion. So it must be valued by a valuer appointed by trustees. And this must be done every 2 years. People make that mistake. Oftentimes you see an issuer telling you that, oh, we just value the assets, But no, as a trustee, you must insist at the point of your appointment to be sure that, yes, you value the asset and sure that, okay, it's able to accommodate the exposure in question. Then number 3, you must be able to visit the asset to know that, yes, genuinely this asset exists. and that is not once, twice, several times you have to keep visiting the asset. Imagine if there has been a depreciation in the asset, and then you sitting down there as trustees, you assume all is well. You realize there has been a problem over the period of time. The other thing which is very important, is insurance of the asset, especially where there are other assets outside of land and the rest. You must be able to insure the asset against fire, against other perils. At least that gives a kind of confidence to the market that yes, in the event of anything, then the insurance is there. And all these parties that work, it is the responsibility of trustees to appoint them, because your trustees' role is to ensure transparency. You are like a referee in the field of play to make sure that everything goes on. And lastly, and that's why we work with firms like Banwa and Igudalo and the rest, you must be able to put the security documents together. That company has assessed with 500 billion, this is what happens before, this is what happens, this is time of payment and the rest. Now, when you have finished that stage, that is pre. Now, like I love when Ulishaji was speaking, that when others have finished their job, that's when trustees' job even starts. You have packaged the offer, the fund is there, then everybody has gone away. That's when the job trustees' responsibility starts. Because at that stage, there are 3 stages involved. One, you must always monitor the issue to make sure that, for instance, how are they doing financially? You must collect the audited reports annually to make sure that, yes, what they have collected, they are still able to, at least they are paying, they are repaying, and everything is going on smoothly. If there is a major change in the management of an issue, then that is a signal for you as a trustee to know what exactly is happening. Is everything all right? Because the investing public at that time is looking up to you to ensure that everything works out perfectly well. Now, the other thing is the second aspect after monitoring the issue is to monitor the project itself. The fund that we have raised, what's the purpose for which the fund has been raised? Is it being channeled to the project? For instance, the company has said, okay, yes, you want to build a plant in Kaduna, and now you realize that after some time, the plant is not there, everything is not going on well. So that's a red flag for you as a trustee to know that, yes, there's a problem, and you quickly do the needful. And lastly, you also have to, in the event of when everything has gone bad, and then the issue is unable to pay, that is even more tough for a trust company, because that is the stage where you have to step in and realize the security. And how do you do this? You have to work with a receiver manager, because the trust deed that governs the entire relationship in the ecosystem has given you that power to appoint any parties. So you have to quickly step in, appoint a receiver manager, and realize the assets immediately. And then make sure that everybody is happy, the investing public. And then, so you can see that the trustees' role is very, very critical in the market, before, during, and after. Let me also say this before I pause. When it comes to state government, the same way corporates borrow from money, that's the same way that state governments also do the same, they borrow. However, because it's a state, they are not allowed to pledge any their assets, securities, as it were. So how do they do their home? They have to open what we call a sinking fund account with a trust company. The sinking fund, on a monthly basis, the state deposits the money with trustees for the payments of the exposure to the investing public. So typically, the money coming for 6 months, and after 6 months, you pay out. You pay out. You pay out to the bondholders. So the other thing which is very critical to a trustee, let's imagine everything goes bad. ISPO, irrevocable standing payment order, which a state government would typically issue in favor of trustees. What does this mean? It simply says that, look, there is a default on the part of the state. So you all agree with me that trustees' role is very, very sensitive. It's very important is very important in the market because once anything goes wrong, all eyes are on trustees. So that we don't wait until things goes wrong. We try to act. So let me pause there so that I can allow the participant, other panelists to also speak. Thank you so much, Amala. Thank you, everyone.
Thank you very much, sir. Thank you very much. It's safe to say that the trustees play the role of a guarantor. So it simply means that should anything go wrong, yeah, we get to activate, well, let's call it the security now with them. And so, yeah, they are there to ensure that even if things, don't go accordingly, at least the interest of the investors are covered. And so, and of course, yes, they also play the role of accountability partner. I think that's also another thing I've been able to pick from that conversation. Now, I would like to direct my next question to Mr. Ademola. And of course, is in line with what Mr. Orishajimi, talked about while he was trying to explain how rating works and how, take for instance, those, in the pension industry and are not allowed to dive into risky instruments, some sort of. And so my question to you, Mr. Demola, is, of course, what categories of instruments or sectors are most attractive to pension funds today and why?
Thank you so much. And good afternoon, everyone. I hope you can hear me.
Yes, I can hear you clearly, sir. Thank you for being here.
Okay, thank you. And let me also thank the PAC group for this, for putting this together and, creating this kind of awareness and trying to, develop the, capital markets. Going by the question, let me start by saying that one, it may be difficult, so to speak, to say this is the particular instrument or particular sector because the kind of fund we manage, we don't manage a single fund. So what is attractive to fund one may not be the case for fund four. I'll speak to that later. But for us as a pension manager, the kind of liability we carry is a long-term liability. So ordinarily, one would expect that should also determine the kind of instrument you have in our various portfolios. But for us, in Veritas Glanvis Pensions Limited, for every investment decision we take, we put them on three pillars, so to speak. We have three pillars, and I will speak to them quickly. The first one is before we go into any investment or buying any instrument, what is key is the safety of that instrument. What do I mean by safety? It means that will I be able to recoup my investment? Even if I'm not getting any return on it, will I be able to get back my money? So that one is key. So we look at any instruments in the market or any investment. If this part is not clear, then we can't go near it. Another thing is competitive return. Am I going to get competitive return if I go into this investment? Because you all know that one hour of yesterday does not have the same value with 1 naira of today. So what we mean by that is we need to get competitive return on any investment we are going into, just to ensure that we preserve value. Because if I say I'm a manager now, I'm a fund manager, and what I'm just getting is keeping your money for you, make sure we don't get into a bad investment. But at the same time, if the value is not really there as a sort of inflation, then it means that I've not added value and I've not preserved, your capital, so to speak. So competitive return is another, key pillar we look at before we go into any investment. And the last one is the issue of liquidity. If I go into this investment, if I want to get out, will I be able to get out? Okay, I've invested in a particular instrument that's, say, a debt instrument that has 7-year, tenor. And along the line, maybe the 5th year, I need to exit that investment. Will I be able to get out? Or if I have an obligation, because, as pension manager on daily basis, we have need to meet up, obligations to all our RSA holders. So if there's a need for me to do that, will I be able to, get out of that investment? So when we look at these 3 pillars, then we can now say whether a particular, instrument or investment is attractive to us or not. Now, like I mentioned earlier when I started, what is attractive to Fund 1 may not be attractive to Fund 2 or Fund 3 because of the fund type. For sake of clarity, our Fund 1 is a kind of fund that those that are below 50 years of age can, we can put them in. Let me just put it this way, that we have different funds we manage. Fund 2 is a default fund. When people join today, start a career and they sign on to, a pension RSA account. So the first thing they do is, okay, by default they get into Fund 2, but by option they can say, oh, take me to Fund 1, because Fund 1 is a bit aggressive. Let me use that word, in the sense that the kind of instrument Fund 1 can invest in. Whereas we are talking of Fund 4, which is a retiree fund. It's a lot conservative. People in that category, they are retired, so they don't want to get into any instrument with high volatility. So we need to preserve. So like I mentioned now, what is attractive to Fund 1 will not be attractive to Fund 4. Now, let's now go down to the question now. Because of the nature of our business, what we try to do is try as much as possible to outperform inflation. And in doing that, the category of instruments that can make us achieve that are the variable income instrument. And when you're talking of variable income instrument, we are talking of equities. We are talking of alternative investment. And within alternative investment, we have the likes of REIT, like it was mentioned the other time. Today we have infrastructure fund, which are fundraised to meet some infrastructure gap in the economy, and of course given to private entities. And then of course we have the private equity funds. So these are areas or the asset classes that can be attracted to Fund 1 and Fund 2 because of their own nature and because of the category of RSO that we have there. But of course for Fund 3, which is for those that we are preparing for retirement, people that getting towards their retirement age, and Fund 4, which is of course purely for the retirees. Then we'll begin to look at some fixed income instruments that can get us some stable income and of course reduce volatility on the RSA balances. So then we'll be talking of commercial papers. You recall that the last 2 years we have seen lot of that in the market, and in fact last year, because of the influx of you see everybody coming up with CP made even a regulator to say, what, we need to sit down and really look at this, and they stopped us for investing in CP, but later they lifted that ban. But of course at the beginning of the year they came up with what I call a structure regulation, saying that you can only invest in A-rated CPs, like Mr. Jimmy mentioned the other time, talking about investment grade. Ordinarily, with a BBB, you should be fine that, this is an investment grade, I should be able to invest in it. But now, because of the need to really regulate and ensure that as pension fund managers, we don't burn our fingers. So they try to raise the bar. So when you now look at it, you now discover that for Fund 1 and Fund 2, yes, variable investment, variable income instrument. But for Fund 3 and Fund 4, then maybe tilting towards some, fixed income instruments that, can really enhance, return on investment. So now, if you now talk of the sector now, even within the equity space, then we can be talking of course, the financial services and banking stocks, which, of course, we all know that this class of equities is the driver of the market. So, and of course, we can see it from what they have done, and of course, in their figures, terms of dividend payment, capital appreciation. Of course, everybody wants to have them in order to, enhance return. And another sector we look at is telecom. I'll give you an instance. At the beginning of the year, a particular telecom close at 200 naira per share. As of today, it closed around 357 today, and that's about 79% capital gain. You cannot get that in whether FGM bond or any other fixed income instrument. So those are the kind of things we look at. And agric, if you also look at agric, you discover that the two prominent two names on the Nigeria exchange, they've done pretty well this year. And if you have that kind of thing, the kind of stock in your portfolio, of course, there's no way you will not beat inflation. So those are the kind of instruments we look at, and those are the names that will attract us depending on the kind of fund we are talking about. Thank you.
Thank you very much, Mr. Ademola. Thank you so much. That's a lot. And honestly, I think that's the kind of insight that we look forward to getting, whenever we have conversations like this. Now, I would like to move to the asset manager in the house, and that's PAC Asset Management, Mr. Bamidele Ige. And the reason why I want to move to him now is, of course, he's also a player, just like Mr. Ademola, right? And of course, they are the ones who help in investing, who advises on, where to invest your funds, and all of these things, And so, riding off of the last question, Mr. Bamdele, I would want you to talk about how you manage the trade-off between liquidity and long-term value, right? Particularly when investing in primary and secondary market instruments. Of course, Mr. Ademola has highlighted, the peculiarity for them and the things that they look out for. And so one thing I know is liquidity and long-term value is something that, it's similar across both managers. And so I would like to get your perspective on that. Now, how do you, as an asset manager, as a fund manager, how do you manage the trade-off between liquidity and long-term value, particularly when investing in primary and secondary market instruments?
Okay, thank you, Malala, and good evening, everyone. It's a pleasure to be here to share our own points of view about the ongoing conversation. First, I'd like to start by saying that a fund manager is one of the closest capital market operators to the investor, in that we do the last mile. For want of a better word, like you have in the telecoms industry, they talk about last mile. We do the last mile along with the securities brokerage firms. So that's where we play. We have, a face-to-face interaction with the clients or with the investors, and we get direct feedback from them. What do they want? What do they want to receive? How are they hoping to invest? What are their concerns about investments? That's the first thing. And as Mr. Ademola has said before, he has, sort of hinted at it that, look, the role of a fund manager really is that of a risk manager. Your clients do not want to give money to you, and when they come back for their money, they can't find it. Even you would be ashamed of yourself that, look, what have I done? So first of all, note that the role of a fund manager is that of a risk manager. Now, when we look at the trade-off between primary market, secondary market, and liquidity. I would answer the question by saying that, look, the primary market and the secondary market are two sides of the same coin. The secondary market basically helps the primary market to create liquidity. Otherwise, without a secondary market, people would buy investments and have to stay in that investment until maturity or until it goes bust. Sorry. So that is the rule that the primary market and the secondary market have to fit in. Now, in terms of how do we manage the trade-off, it's a simple thing of strategic and tactical asset allocation. Strategic in that you know that, look, part of my asset is allocated for long-term purposes, you understand, and tactical to provide liquidity if and when the need arises. So within a portfolio, you construct your portfolio in such a way that you have those assets that are regarded as strategic, those that are regarded as tactical, and if you need to make or just urgent adjustments, you refer to your tactical part of the portfolio so that you can maybe cover immediate liquidity needs and so on. Now, in doing this, you have to be conscious of the risks inherent in whatever you classify as strategic and whatever you classify as tactical. You also have to be on point, monitoring your portfolio all the time, because even things could change around the strategic allocations within the portfolio such that you need to make adjustments to prevent a risk crystallizing and to ensure that, look, your portfolio does not become illiquid when eventually you need to really access liquidity. So for us, for me, the answer to that question is simple. An allocation between strategic assets and tactical assets is quite important. Make sure that you're monitoring your portfolio to make necessary adjustments as required. I will stop there. Thank you very much.
Thank you very much, Ms. Daige. Please stay with me. I would like to, take the second question that I have for you, and that is, what trends are currently, or should I say, are you currently seeing in investors' preferences, and how should issuers position themselves to meet those evolving expectations?
Okay, great. Interesting question. And I'll start responding by saying, first of all, a Nigerian investor, and I think all rational investors are naturally biased towards the return that comes to them. So as an investor, I'm not going to make an investment on the basis of emotions. I'm not going to make investments on the basis of, I like this person that is, you understand, my investment decisions are usually based on what kind of returns am I going to get? What is the risk I'm taking on this portfolio? Is there safety? And a lot of these things have been mentioned by my colleague on the pension fund side, Ademola. So, I will not bore you with those details again, but those things are important. And then the question is, how do issuers need to position? In Nigeria today, the go-to type of investments, you talk of equities, you talk now commercial papers. Those are trending at the moment. Commercial papers are trending. But one thing you discover about trending instruments is at some point they go out of fashion. 2016, 2017, it was treasury bills that were trending. Every single investor you spoke to wanted treasury bills. They will not take placements from you. They will not take even federal government bonds. Why? The Nigerian investor, again, is innately short-term in nature. You understand? Innately, they're short-term in nature. They just want to get in, and in 3 months, they're getting out.
All right. Thank you very much, Ms.
The Nigerian investor is not comfortable with volatility.
Sorry. I thought you were.
Can you hear me?
Sorry, there was a break.
Lola?
Yes.
Can you hear me?
Can you hear?
No, I'm not done.
All right.
Okay. I was saying that the Nigerian investor is very uncomfortable with volatility. You understand? That's one of the other challenges that we face in the market. The Nigerian investor doesn't want to hear that, look, I've invested today in a mutual fund, for instance, and even though I bought one unit at 100 naira per unit, for instance, tomorrow it is 99.9. The next thing you see is a redemption request that I want to take my funds away from there because it's losing money. What they don't understand is, look, there is an investment horizon. So what that just tells you is the Nigerian investor is skewed towards money market rather than the capital market. And the first thing you know, how you address that is the need to create that orientation that, look, money market, yes, is good, gives you immediate return, but capital market can give you multiples in terms of returns. There's need for that orientation. And then you talk about how should issuers position. First of all, one of the other trends, aside from ongoing interest in commercial papers and treasury bills to fixed income instruments, you find that Nigerians, investors are interested in foreign exchange. You understand, FX denominated investments, one for preservation and then for capital appreciation. We've seen what has happened in the past 2-3 years in terms of exchange rate. And people have noted that, look, if I bought some USD at some price and I'm converting back today, it's going to give me multiples of the amount that I invested. And if I were to put a rate of return on that, it could be more than 100% to 200% or even 300% if you like. Now, the other areas that you begin to see Nigerian investors, focus on would be cryptos. Those are the digital assets, private debt. More and more, we're seeing issuances of private debt, on the sides of the commercial paper issuances. Then there's more attention to infrastructure, but of course, in that space, you find that it is more of the qualified investors that are patronizing the infrastructure funds and all. And then there is the age-old investing in real estate thing. An average Yoruba person or an average Yoruba parent will advise their children that go and buy land and build house. So real estate, land, and housing is one of those things that really interest people. And then we begin to look at the space of the alternative assets. And what you begin to see now is, whether we know it or not, people are paying more attention to the entertainment industry. It's more like money spinner these days, the musician of money. And so whether unity is beginning to focus more attention on that. So, it is for issuers to see, especially these new areas in the alternative industry, to be able to bring them to the fore and let investors see, look, there is a prospect for you to really maximize your wealth in these spaces. And so those structures need to come up, and then what else do I talk about? There's also private equity and venture capital. Of course, the vehicles that are being used to invest in the entertainment industry are the venture capital structures that people put money down, make your movies. When you sell it and you make a profit, you take a share of it, and everybody walks away. Of course, there's the commodities instruments too in the agricultural space. Again, we need to begin to look at that. And one advice I'll leave for my colleagues in the investment banking is the fact that, look, let's begin to explore the possibility of tokenizations for cryptos and all. We've seen issuances using the traditional style. Maybe we now need to begin to look at crypto tokenizations. Thank you very much. I'll stop there.
All right, then. Thank you very much, sir. And we really appreciate you for your time. Of course, we're getting to the end of the webinar, but before we go, I would like to ask Mr. Orishojimi a very peculiar question. And of course, it has to do with ESG investment. While Ajovi was talking about different instruments within the capital market, he touched on green investment or green bonds. And so, with respect to that, I would like to know how rating agencies like yours incorporate sustainability into assessments, and how should issuers respond?
Okay, so what we've done at Augusto is to incorporate quite a number of ESG components. So there are two folds to this. First, Augusto has been certified by the Climate Bond Initiative to help with certification of green bonds. So we're about the second or third. With the second company in Africa, we've got an Africa license for that, which means we can certify a bond under the Climate Bond Initiative's platform. We can certify a bond to being green across Africa. So that ordinarily deepens our expertise on sustainability and green issues. So what we've done with that deep knowledge, and on the other hand as well, we've also got certification to issue second-party opinions. And we're doing quite a bit of that. We helped Lagos State with the CBI verification of its bond that it will soon issue. We helped the federal government also obtain a second-party opinion. So on the back of that knowledge and experience and expertise, what we've done is to incorporate ESG components into our regular ratings grid. So in addition to every other thing that we evaluate on the ratings grid, we've also now incorporated ESG issues, ESG factors into our regular ratings grid, which means that beyond just having good financials, beyond having stable management, beyond having a strong board and strong corporate governance and frameworks and all the other things that could help you achieve an investment grade rating, you should also have eyes on your ESG components, your environmental, your social, and your governance issues. So because that is now part of the rating factors and the rating evaluation. So issuers need to stop seeing ESG issues, ESG factors as a nice to have. It is now a must have because we have incorporated it into how we rate companies. So considerate of time, but just thought to check that.
Thank you very much. And of course, I would like to crave indulgence for just a little more time. I want, but thank you very much, Mr. Orisha Jimmy. I would want Mrs. Aziza to just take one more question before she leaves. Of course, because we're running out of time, we might not be able to, accommodate a Q&A session. But of course, the very last question that I want Mrs. Aziza to speak to is what she thinks issuers should keep in mind regarding legal risk when navigating cross-border capital market deals, especially companies like PAC Capital that is focused on borderless capital solutions. And so my question to Mrs. Aziza is, what do you think issuers should keep in mind regarding legal risk when navigating cross-border capital market deals? Thank you. Just if you may speak to that briefly, that is.
I'll do that. I'm mindful of the time. So in cross-border, so from the description of cross-border, it means we are dealing with more than one jurisdiction. So the first thing you need to be mindful of is that you have two jurisdictions, and so you have two applicable laws to comply with. If you are a Nigerian issuer, you have your Nigerian law mandatory provisions that you need to comply with. You have the Investments and Securities Act, you have the Companies and Allied Matters Act, and then you have your sector-specific regulations. Then you now have the requirements of that jurisdiction where you want to offer the security that you need to comply with. You need to comply with their securities offering law, and you issue to members of the public. And if you are going into the US, it's stricter than any other jurisdiction. So they have very detailed rules in terms of even how prospectus is drafted and the kind of English you can put in the prospectus. Then the other thing is your corporate governance requirements, right? The corporate governance requirements, thankfully, we seem to be generally at par with most jurisdictions. in terms of requirement from a corporate governance perspective. So that used to be a difficult one for most Nigerian issuers to comply with. But these days, it's relatively easier because of the Nigerian Code of Corporate Governance. You also have the SEC Corporate Governance Guidelines, and if it's a bank, you have the CBN Code of Corporate Governance Guidelines, which again are not so far apart. They represent best practice. Then the third thing that we need to be mindful of are things around capital gains, because the investor wants to know what the tax is like. Withholding tax, for example, if I'm issuing bonds, is it going to be subject to withholding tax under Nigerian law? If I'm earning dividends, if it's equity, will it be subject to withholding tax under Nigerian law? Are there double taxation treaties between that jurisdiction and Nigeria that may offer some sort of leeway to an investor? And then the other thing we see quite often that investors sometimes struggle with is in FX. So the money needs to come to Nigeria. You need to get certificate of capital importation and comply with the requirements of the foreign exchange market. Now, for the banks, it's a bit more difficult because, particularly when it's equity, because CBN needs to approve the investors. So there's the clearance process for the money that banks raise in an equity raise. Brought in your money, when do you get your CCI? You're waiting for CBN to clear. So again, it's one order that we always have to engage investors. Unfortunately, it's a requirement of Nigerian law that CBN needs to clear the money if it's equity raise. And until that clearance happens, the bank cannot allot securities. So we just always advise that do a regulatory map, right, of the requirements under Nigerian law, the requirements in the jurisdiction where you are going to, and see what approvals you would require. So you are clear in your disclosure, because disclosure requirements over there is very stringent. And then the last thing I'd like to add is for Nigerian banks that are working, or investment banks like PAC Capital, working with a potential Nigerian issuer, you need to get them ready in terms of due diligence. I mean, I've worked on at least 2 transactions that didn't proceed because in the course of due diligence, certain questions were answered and certain disclosures came out, and international banks could not proceed with those transactions. So it's important that you know the issuer, do your own diligence before the international banks will do their diligence. Identify the gaps, work with the clients to fill in those gaps to the extent that you can fill the gaps within the confines of the law, and get them ready before you take them to the markets.
Thank you very much, Mrs. Azza. To be honest, I think today's session has been very exciting. And of course, it would be nice to have this kind of conversation as a live event, formal engagement, whereby we have enough time, to take a deep dive into, these conversations. Because, say for instance, I still have plenty of questions that I've not asked. But then, of course, we're being mindful of time and we want to uphold our promise to our attendees. And so, at this point, I would like to invite Mr. Patrick Kanoye, who is the head Global Funding Desk and Trade for PAC Capital, to close us out officially. Thank you very much.
Thank you very much, Omolala. Thank you. Yeah, it's been a very, very insightful and productive session. I must appreciate everybody and appreciate the panelists for the thoughtful idea, the insights provided, the perspectives, they are highly valuable. Going from the role of better marketing and economy, we have seen that it is a very vibrant and active capital market actually leads to a sustainable development, and that we cannot take for granted. Interestingly, also, we went into the rating agencies and the role they play, and Jimmy provided a very insightful lessons telling us that they are market guidance, which is very, very useful for us to understand. Seeing how they evaluate risk. However, he brought in another dimension that investment grade is not the only one that we can also look at. There are other junk market investment that we can also, really go into. And those perspectives are very, very wonderful, trying to dimension the grading and the role they play. Adrovi also throw light on the instruments, the innovative capital market instruments, like the green bond, talking about the yield, the crowdfunding, and all of that. These are also quite insightful for us. And Aziza also brought up the legal perspective, and it sounds very, very interesting because it says that they are also solution providers and are not just really there to cause any confusion. Also trying to say that they are problem solvers and partners, and we have seen how they do that. They actually de-risk most of these instruments for the regulators and give them a regulatory comfort and governance and all of that. This is quite insightful, and we're really hoping to see some of you back. And Yinka, our own Yinka, also actually clearly spell out the role of trustees. And to me, it is quite profound because we have seen end to end the sensitivity of their role from the beginning, before, during, and after, in terms of the collateral management and in terms of the assets monitoring, and even to realize those in the case of default, using the receivers manager and all of those roles. So it's quite interesting for us. Then we also had Ademola, trying to tell us how they carefully choose what they invest in. Given the fact that they were housing different buckets of funds. And it sounds very good. Safety of the instrument, competitive returns, and liquidity. So these are things that also caught our attention, and we're also going to be looking at it because we're market pension funds, and we have seen how they analyze their risk. Then Lele, for example, also has seen telling us that they are the grassroots people. They are the ones that actually, work with the investors face to face, and they are their risk managers and actually trying to make sure that they put them in safe havens. So thank you very much, everybody, and on behalf of the MD CEO of PAC Capital, I must thank our external people, first of all, Aziza, Orise, Jimmy, and then Mr. Ademola, for the time deployed and the knowledge they have also deployed in this particular assignment. And our own in-house resource, we don't take it for granted. Thank you very much, and we wish to do this collectively again. Looking forward for the next session. Thank you very much, Ola, for coordinating well and actually putting things together. And every participant for listening, and thank you for your time.
Thank you very much, sir. Thank you so much. And of course, yes, I would like to say we're officially at the end of this webinar. A big thank you to our brilliant panelists, our hosts as well, PAC Capital, and of course, all of you who joined and stayed with us today. We hope you leave better informed and inspired to engage the capital market for value optimization. And so officially, we'd like to say thank you. Thank you, everyone. And of course, stay safe and stay dry. And we hope you have a lovely rest of your day. Thank you.